Most trading strategies being taught out there don't really have an edge. This means that even if you trade them with discipline, you will lose money, which means that knowing how to develop your winning trading strategies that not only fit your style, but are actually profitable is possibly the most important skill you can learn. And that's exactly what we'll be teaching you in this video.
In today's video, I'll be discussing Developing Trading Strategies 101. For more videos and content like this, you can follow me on Twitter at TheOneLanceB. So one of my favorite quotes from maybe the most popular physicist of all time, Richard Feynman, he says, "The first principle is that you must not fool yourself, and you are the easiest person to fool." So what happened was a couple weeks ago, I made a tweet that ended up being the most liked, most favorited tweet that I've ever had. And that really signaled to me that I was onto something that was really resonating with the community. And that tweet was this: my number one FinTwit observation. Most failing traders wrongly attribute their struggle to issues of psychology and risk management. The reality is most have zero edge. They have naively been fooled by randomness into thinking that their wins are edge. This seduces them to troubleshoot the wrong problem. The best analogy I can give to describe this is many struggling are putting the cart, meaning risk management and psychology, before the horse, which is developing and having strategies with edge. Then when it doesn't go, they wrongfully think the issue is the cart and they go on to troubleshoot the wrong stuff. And don't get me wrong, both are important. You absolutely do need risk management and psychology, but all of it is useless if you don't have a true foundation of strategies with edge. No matter how good your risk management is and your psychology is, you absolutely will not succeed at this job. So many people kind of put up, very good counter arguments to this, but the ultimate counter argument that I made is I know many, many successful traders, 6, 7, 8-figure traders that have awful risk management or awful psychology, but they were as successful as they were for one good reason. They have enormous, enormous, enormous edge in their strategies, and that can cover up a lot of that. But if you have strategies with no edge, say you go to the casino every day, whether it's blackjack, roulette, whatever, slot machines, no matter how good your risk management and your psychology are, no matter what you do, you will lose money if you have no edge. And so how did I come to this conclusion? Many were asking me that. And so this is based upon tweets, daily report cards that are sent to me, and direct conversations with an assortment of traders in the retail trading community. I've spoken with probably dozens and dozens of traders. It might be at Traders for a Cause in Vegas. It might be at some of the happy hours I attend. I've gotten a pretty good feel of what the community, what their strengths are, what their weaknesses are. And I've met with people at all levels. And for so many of the traders that are struggling out there, I understand this and I know what your problem is, but so often they say, oh, what I need to work on is my psychology. What I need to work on is my risk management. But when I learn more and ask a bunch of follow-up questions, one thing becomes clear to me. It's none of that. Their true issue is they're not trading strategies with edge. And Bella's noticed the same exact thing. So I feel you. I know how hard it is to build edge. And in response to everybody on that tweet, this is my video to you all. So you can start to build edge for yourself, and I'm here to help.
If you want to learn 3 real-world setups that our professional traders use, including the simple but highly effective setup that we teach all of our new traders, and the setup that turned one of our traders into a 7-figure big money earner, check out the free online trading workshop that we're currently running. This is a 100% free, intensive workshop where you're going to learn more in a couple of hours than from years of online education. So don't miss it.
So what is trading edge? In trading, edge means a trader strategy that is positive expected value, essentially EV greater than 0. And so what's EV? Expected value is the probability you win times the amount gained if you do so. Then you subtract out the probability of losing times the amount lost when that happens. Many beginner traders are fooled into thinking their win streaks are due to their strategy, yet then their loss streaks are due to shortcomings of psychology or risk management. In reality, their trading strategies don't have meaningful edge, and the win streak was just part of inevitable variance. A really great book on this topic is Fooled by Randomness by Nassim Taleb. It's kind of like the Bible that traders rely on as they talk randomness and black swans and everything else. Very, very popular, and it really hits home on a lot of points that I'm discussing. Because so many traders, you're inevitably, right, if you were to flip a coin and it would be a 50-50 chance of heads or tails, you're inevitably going to go on these win streaks. And if you were flipping a coin and it landed heads, at no point would you think, oh, that's just because I'm doing everything right. Then if it was tails, you wouldn't think, oh man, I just became overconfident, right? But what so happens with beginner traders is they get fooled into overinterpreting their data. Especially, what's so common is I'll hear, oh yeah, I was winning for 2 or 3 months, but now I've been on a 2 or 3 month loss streak. Well, guess what? Odds are that that's just kind of the correction of that inevitable variance. So how do we get you all some real edge? So first, to be clear, edge is rare and most is noise. I really discussed this in my broken slot machine video. There's only going to be a select few tickers and ops that are exceptional each day. Most of trading is a random walk, especially if you're trading tickers that aren't in play. You'll still be right 50% of the time or somewhere around there, but even with individual days with high win rates, that doesn't mean that in the aggregate, you're a winning trader, right? It all depends about in the long run and how strong that data is. So how do you develop these strategies? So first of all, a few prereqs. You almost always want to only apply these following methods to stocks in play. These are going to be the stocks that tend to have fresh news catalysts, exceptional technical patterns, or stocks that are doing massive volume with big price ranges. And you also want to be careful of hindsight bias. You can't just simply look backwards and think everything is so obvious in retrospect. You need clear, predictable criteria that you're going to be able to apply in the future in real time. So I made this little table for you all. The way I think about it is there's 4 general methods of kind of developing and finding edge. Now these are not mutually exclusive. A lot of times they can overlap. The first method is observation. Observation is where you're actively utilizing screen time each day to notice patterns, correlations, and predictable price action. And as you can imagine, there's pros and cons of each method. So the pros for observation is it's easy to do during slow markets. It requires minimal mental commitment and it's accessible to all traders. Anybody can do this that's sitting at their desk. The cons of this, though, is it can have a low hit rate. Oftentimes it can be time consuming, but it might take a while to actually yield anything. You can go down a lot of dead ends, but like I said, not too costly a strategy to find edge, so no harm done most of the time. The second method is hypothesis. Hypothesis is a logical idea that you can then backtest or forward test to see whether it might hold true in the market. The pros of this is it tends to have a solid hit rate on logical ideas, and it's also accessible to everyone. The only cons are it really does kind of require creativity. You really need a lot of brain power to always be thinking up new ideas that are reasonable and rational. And don't worry, I'm going to always get into a lot of examples of these too. So the third method is reverse engineer, and probably one of the most powerful methods. And this is looking backwards at past moves to identify predictable variables and setups that you can use to develop a systemized strategy. The pros of this, it has a high hit rate and high accessibility. Again, pretty much anyone can utilize this using public screeners to analyze big movers and other tools at the average retail trader's fingertips. The cons, though, is you must be able to identify and properly systemize these so that you can capture them in real time. You need to be really careful of false positives or really developing some hindsight bias, which we can get into. Then finally, the last of the 4 methods is mimicking. And what that is utilizing an external source for trading strategies with the presumption that they have edge. So the beauty of this is probably the most effective and has the highest hit rate and is the highest and fastest kind of path to learning and finding edge. But the biggest con is its low accessibility. It requires you to have a mentor, access to others with edge, or some other source that gives you a profitable strategy. So it really requires someone that's willing to share and your ability to kind of delve deep into that. So now let's further break these down and give you more of an example of what I'm talking about. So observation. Let me tell you a little story of some edge that I found that was through observation. Back in 2016 or so, probably each month we would notice that the gun stocks would just pop out of nowhere one day a month. Smith & Wesson, Sturm Ruger, RGR, these would make some massive trending moves. we would then try to figure out, why did this happen? Was it a technical breakout? Was there some type of news? We scoured and scoured the internet. And sure enough, having observed these moves, what we were able to find after studying these certain days is a monthly gun sales report was coming out. I can't tell you why this report was so relevant to the market then, or why this was so in play at the time. But what I found out was that each month we were able to find where this report was being released, figure out what the estimates are, and be some of the first to be on top of these really massive moves. And all of that came from observation. I didn't have any hypothesis about this. I didn't have, any other, preconceived notions. All it was is I noticed gun stocks were making a massive move one day each month, and then I did my best to try to figure out why. And a more recent example is a trade I did this year, MSTR. So MSTR was a massive capitulation play versus Bitcoin. And I've written this publicly on my Twitter, but I'll go into it again now. Essentially, MSTR holds a ton of Bitcoin. And so really, because the whole company is essentially just a tracking and holding of the assets of Bitcoin, it really correlates quite well with the underlying price of Bitcoin. And if you see this chart that I pulled up on Bloomberg, for many, many months, MSTR was tracking very, very closely. Of course, it's not going to be perfect. There's a lot of other variables, but anybody can tell that correlation is quite strong. So then, going into the spring of this year, as Bitcoin was panicking and so was the market, MSTR started to hugely diverge from the price of Bitcoin. If you were to look at those numbers, that type of divergence in percentage terms is crazy. So now we're going to go deeper onto some of the charts. So what you found was MSTR versus the price of Bitcoin, given it was just kind of holding the asset, we probably had a 30, 40, 50% divergence from what the underlying was doing. And it was doing this in a very capitulatory manner. And so again, I didn't have any hypothesis. This wasn't anything that I had been planning on doing. The only way I found this trade and was able to make this long capitulation trade in it was simply by observation. I had noticed how strongly MSTR was selling off versus Bitcoin. So because I was watching that, I was then able to structure this trade and set that up. For the full details, please just check it out on my Twitter. Kind of goes beyond, multi-page details that I can jump into in this video, but that was an example of another trade I found this year solely due to observing the market and wondering, why is a stock moving down so much more than Bitcoin? So now, hypothesis. Let me give you a couple of examples what this is like. Example number one, if the market and IPO market in particular are very strong and hot, do IPOs that hold above their pricing tend to trend higher on day one? Right? So I've not observed anything. All I have is a logical hypothesis, right? If the market is very, very strong, if the IPO market itself is very, very strong, is it a safe assumption to think that these might trend higher over time if already exhibiting positive bullish signals? The second example is hot IPOs that are strong all day and finish strong. Do they have positive EV if you overnight them for a gap up? And you might think these are pretty easy, simple hypotheses, but the reality is these have really good edge. These are both strategies that I have traded in the past during strong bullish markets. Another example is in the current bear market, do excess gap ups tend to get sold off? Essentially the inverse of buy the dip. Do people now sell the rip? So what I'm doing is I'm using logic. I'm thinking about something that makes logical sense, right? In a bull market, IPOs tend to go up regardless. So in an extra strong and an extra hot market, is there an actual actionable trade? And vice versa, in a weak market, can I actually do the inverse of buy the dip? These are very logical hypotheses. It's very simple then to kind of collect your data, monitor these, and build a database of such a thing so you can analyze it quite analytically and quantitatively. And so then next, we're going to analyze reverse engineering. This involves finding the most exceptional moves in the market each day and then documenting them, studying their charts and categorizing them to identify patterns and common variables. So one way to go about doing this is you can create scanners based on stocks up or down the most and that day, or maybe by various market cap levels. Maybe you can study the ones up the most each week. You can study stocks that are doing the most volume versus normal. And what you can do is start to look for patterns in this. You can use a program like Evernote to build a database of charts and categorize them by those patterns, then try to isolate the various variables over time. Maybe the stocks that are up the most over the last month are all low float stocks. Or maybe the stocks that are up the most are all energy. Or maybe it's growth that has been screaming back. And you're able to start to suss out those variables. So let me give you a more concrete example. One of the craziest moves of 2022 so far was in HKD. So let's reverse engineer that. So I'm going to take the chart on the left, and that's just the daily chart. And what we're going to do is we're going to look back and we're going to isolate where the move started. So then we're going to try to document all the variables of the pattern and start to build this database. So HKD was a low float IPO. Recently in 2022, these had all been ripping way above their pricing. And so in this specific daily chart, when I zoom in, what happened prior to that really parabolic, insane move is we had a huge volume breakout a few days prior. We couldn't pull back. And then we break out again to highs. And what's so interesting is what must have happened is in a low float stock like this, after the big initial move, you end up a lot of people short. It tries to pull back. Then when we break out that second time, so many people that are short can end up trapped. And so what I would do is I would be taking these charts, I would be tagging them in Evernote. It could be low float IPO, it could be daily breakout, it could be intraday aligning with the daily breakout. And what I also notice is using a trailing stop of daily bar lows would have allowed you to at least hold and capture this move. So again, it's just one data point. I'm not going to make it a strategy. I'm not going to think I'm done yet. But all I'm going to do is start to build up this database over time. And you can start to do this for mean reversion plays. You can start to do this for breakouts like this. You can start to do this for IPOs. You can start to do this for whatever was making the biggest panic moves, whatever was making the biggest up moves, whatever was trading on the biggest volume. You can figure out and reverse engineer why those happened. What are the commonalities? Do they all need good volume? Do they all need to have high short interest? Do they all need to have low floats? So that's kind of what reverse engineering tends to be about. And then the final strategy is mimicking, or as Bella would like to say, copy the masters. And while mimicking or copying the masters might have a bad connotation, there's absolutely nothing wrong with it. There is no award you get for having the most original strategy. The reality is every successful trader has stood upon the shoulders of the ones that have come before them. There's nothing truly innovative this day. It all comes from learning from others and making it your own. And so part of the power of working at a firm and having, say, a trainer like I did, or having a mentor or a team to provide for you is like they give you that environment and they give you their strategies. You're able to see what are they trading and why. You're able to ask them detailed questions. You're able to learn from firsthand from traders with edge. So this is an extremely powerful resource. But keep in mind, even if you're on your own, you can utilize resources like the SMB YouTube channel or their training camp program. You can find a mentor, or you can begin to copy and document published strategies. Even on FinTwit, there's many amazing traders that have published their swing trading strategies or even their intraday strategies. Then even in books, you have tons of systems like the O'Neill system that have been documented. So don't feel bad about mimicking. The beauty of this is you know that these strategies worked at some point or still do, and you can study them and understand the logic, and you have the power of essentially expertise handing this down to you. It's a very valid way to build the framework for your own. So now where do you go from there? So from there, it's all about developing out the strategy. Like for starters, you can be testing different types of exits. What if I were to use a time stop and say hold for 5 minutes or 10 minutes or for 1 day? What if my stop was price-based? For example, maybe I was going to make a trailing stop using the prior bars, the prior 2-minute bars, or maybe the prior daily bar. Or it could be indicator-based. Maybe I want to be long as we hold above VWAP or a moving average. So all those types of things you'll want to test out once you get the foundation of a strategy. It's so important to be identifying and refining all the variables which might make it better or worse. Let me tell you the story about a trader that told me he crushes IPOs. I had looked through his data and he was hugely biased. He didn't crush IPOs. If there were, say, 20 IPOs that year, he crushed 4 of them and was negging the 16 others. So let's say he made 100 grand in the 4 really crushable IPOs and lost, say 5 grand in each of the 16 others, his performance wasn't that impressive, but he was missing a very key variable. And that key variable ended up changing his trading and really transforming him into an awesome trader. And that variable is he was crushing the hot IPOs. You know, the IPOs like when Alibaba came out and we were in a super strong bull market. He would trade those really, really well and make a lot of money, but a huge chunk of that money he would then lose and give back on all the IPOs that weren't hot. He had it in his head, that bias that, oh, I'm a good IPO trader. And that just wasn't quite refined enough. The reality was he trades the hot IPOs really well and needed to avoid all the rest. And that can really change your performance. Then finally, it's also important to set up alerts and scanners to help you proactively capture these setups. You always want to continue documenting and refine. Building massive databases in Evernote of all the charts and all the write-ups of this will really help you succeed. So look, I understand this probably barely scratches the surface, but the reality is videos on this topic are really time intensive to prepare. I also don't want to overwhelm anyone and go too far or too deep into the weeds just yet. Do you want me to dive deeper on this topic? If so, comment below or let me or SMB Capital know on Twitter at @TheOneLanceB or at SMB Capital. If there's a demand for it, I'll make this a multi-part series and really start to get into the weeds. I'll give you more examples and really start to go through how you can categorize these trades, how you can suss out the different variables, and how to continue developing edge. But this at least will hopefully get you started. So let me know, and I can't wait to hear from you all.
So you're an active trader, not doing as well as you want, not doing as well as you deserve, and you just can't figure out why you can't become profitable no matter how hard you try. Well, let me show you why. This is your competition. The traders in this room. This room right here is full of elite traders, some of whom are making 7 and even 8 figures a year. In fact, our top guys have made nearly 20 million each in net trading profits in a single year. Let's head to my office so I can share more. So you're probably used to seeing videos of lavish trader lifestyles, trading gurus trading off of a laptop for an hour a day, heck, maybe even 15 minutes a day, and then them relaxing on some secluded beach for the rest of the day. Well, all I can tell you is that our traders train like pro athletes. They live and breathe the markets and are continually working on their trading skills. Because at our firm, that's what we found it really takes to make it in this game. I'm Mike Bellafiore, co-founder and managing partner of SMB Capital, one of the world's top proprietary trading firms located in Midtown Manhattan. And we're always looking for trading talent to hire and develop. And not just to trade in-house on our desk, but also to trade from their own home, entirely using our firm's capital. And we have numerous traders doing just that, allowing them to make upwards of 7 figures trading the firm's capital without risking their own money. But to even get a shot at something like that, you need to have the right training. That's why we're doing a new free online presentation in which we share how you can get an interview with SMB to become an in-house or remote trader, trading firm capital without risking yours and gaining access to all of our firm's coaching and resources. And the best part? You don't have to be a profitable trader yet. In fact, we prefer to mold profitable traders with our methods and our techniques. That's why we have just 3 simple criteria that can earn anyone an interview. We're looking for highly ambitious and determined traders who fit our culture first and foremost. So if you believe that could be you, sign up for the free 1-hour online presentation by clicking the link that's in your top right corner of your screen now.